What's up, everyone, and welcome to the daily macro update for Monday, October 13th. Man, what a crazy couple of days in the markets here from Friday to today. Pretty much almost a complete reversal of the major sell-off that we saw on Friday. And so we're going to get into some of that. Still not getting any type of government-backed macro data, only because we are now in the 9th trading day of the government shutdown. And it doesn't really look like that's going to, come to a conclusion anytime soon, at least for this week. So we may not even get inflation data for the month of September. And so we'll continue to get private data, though, which, we can take a look at, some of that right here, as well as get into the markets. But just want to say thank you all for joining, and let's go ahead and get right into this. If you guys have any questions during this, just go ahead and leave those in the comments below. We'll go ahead and answer any type of questions at the end, as well as get to any type of tickers that you guys want me to bring up, and we'll take a look at the ranges there. So taking a look, obviously today, there was a very large rebound from the market crash that was on Friday, pretty dramatic. But despite all of that, though, a lot of bullish trends simply just went to the low end of the trading range. And so right here, I have NVIDIA up. And if I bring up the trading range model for our group, you can see that on Friday, pretty much all it did was go from the top end of the trading range to the low end of the trading range. There really wasn't much of a difference in actual trend changes. There were some sectors that did go from bullish trend to neutral, or from neutral to bearish. But really, the ones that have remained bullish just provided a very good buying opportunity. And so hopefully for those people who are paying attention to this channel, as well as, mainly exposed to bullish trends, hopefully you guys are able to spot those there. Taking a look at the S&P 500, specifically the SPY, as you can see, pretty large down day. I can't remember when there was that large of a drop in price, probably around April. But, taking a look at this huge downward deceleration, it briefly went down to neutral trend, but still, went down to the low end of the trading range for a buying opportunity. And then since then, it has had a decent bounce back to bullish trend, right? So there was a very hyper 1-day neutral back to bullish trend, but the S&P 500 remains bullish. Last night during the Sunday macro wrap up, we had the bookshelf in the background there as a yellow color. But now it is back to green. And so with this recovery, we are right back where we left off. So, yeah, I mean, really, for those things that remain bullish trend, it was just a great buying opportunity. We'll see what happens from here, though. If we do get another down day in the markets throughout the rest of the week here, that could change back down to neutral. But this big drop here, you still have to take that into consideration if you do make any type of newer positions, maybe not going into them as strong, right? But in any case, though, with the SPY, as well as the Qs, NASDAQ, as well as the Russell 2000 with IWM, all of them essentially wicked down to the low end of the trading range for a decent buying opportunity. For those who are in our free newsletter called the Daily Index Ranges, you guys saw that there was an opportunity there and that we were being patient for that opportunity. And so hopefully on Friday, as most retail investors were fearful, hopefully you were taking advantage of that. And so just going through some of the other metrics here, Bitcoin did not break back to bullish trend, though. That remains a neutral trend. Ethereum, Solana, many others remain in bearish trend now. But Bitcoin miners, however, still remain in bullish trend and still near at the top end of the trading range. And so even on that crazy down day on Friday, you didn't get Bitcoin miners near the low end of the trading range. And Bitcoin miners have been the strongest bull trend throughout the entire year. And so, yeah, 2025 has shaped up to be the year of the Bitcoin miner stocks. When you take a look at Bitcoin miners in comparison to Bitcoin, for example, you can see that Bitcoin miners have just completely outperformed it. If we go to just the year to date, Bitcoin miners are up 164%, while Bitcoin is up a little over 19% year to date. If we go back just the last 6 months, Bitcoin is up 37% over the last 6 months, while Bitcoin miners are up over 367%. So a lot of people have been wondering about, altcoin season, Bitcoin season. Well, it's been Bitcoin miner season the entire year. And, this was something that our group was taking a look at buying around, it was about mid-May when we were making our first position around, $16, $17. And ever since then, just been buying dips. And it's been it has been the best performer in our team's portfolios this year. And so that doesn't look like that's stopping anytime soon. But other than, the S&P 500 and Bitcoin, you still have other things that have been outperforming it, such as gold, such as silver, with their respective miners as well. So Bitcoin miner stocks, if we take a look at GDX, for example, silver miner stocks with SIL, all of these have been major outperformers of the indexes. And so that, along with uranium, so a lot of these different industry plays, along with semiconductors, have been the better moves, right? So that, along with tariffs, have just caused a lot of these base metals, as well as the miners, to be the best performers so far this year. So hopefully by now you guys are recognizing this and being able to take advantage of these trends, which I don't think is going to slow down anytime soon. The bond market was not open today due to Columbus Day, so we'll get some more information tomorrow on the bond market. On Friday, though, you did see a large deceleration in the 10-year as well as the 2-year, which was really a recessionary type of signal, which is why the market had such a large crash there, is because it was one of the first consensus recessionary signals that we got in the market, pretty much since the tariff tantrum all the way back at the beginning of April of this year. And then probably the largest development, though, from what our team has been observing, is now the bullish dollar. So the dollar is now in bullish trend, and a lot of people have been, fearful of this, and blaming a lot of this, price decline on the dollar strength, which could have some contributions towards that. But really, when we take a look at correlations, we're not necessarily seeing a large, negative correlation between the dollar as well as risk on assets. In fact, with both the S&P 500 as well as Bitcoin, there is a zero correlation right now between the dollar and risk on assets. There could be here and there for specific industries and sectors, but overall, the dollar bullishness right now is not really having a negative effect on risk on assets. It was mostly that huge tariff announcement scare by Trump on Friday, which he then tried to ease the markets yesterday at around, I think it was noontime, where he told the market not to worry. We're in an environment right now where, unfortunately, the president's tweets are what's going to be the main drivers. It's not necessarily going to be key macro data, and so obviously we do need that key macro data in order to have a better look at what the Fed and the central bank's monetary policy is going to be moving forward. But I really don't think it would have made much change. They're still signaling that they're going to continue cutting rates, even though you have relatively strong growth numbers, right, with the current GDP nowcast for the year being around 3.8%, which is very high. And then as well, you have the inflation nowcast uh, having CPI staying around 3% heading into 2026. And so by just looking at the classical measurements, GDP and inflation seem to be doing well. It's really just a fear of the labor market, which is causing the Fed to signal that they're going to keep cutting interest rates, which that's a whole nother debate if that's truly, why they should be cutting rates, but that's what they're choosing to do anyway. And so what we always like to tell our members, as well as, anyone who likes to follow us, is that um, we shouldn't be trading our portfolios based off of what should happen. We need to trade based off of what the current market is signaling, even if it's something that we don't agree with. So, I mean, that's pretty much what we're seeing right now, right? I'm in the camp that I believe that the Fed should not be cutting as much given the inflation dynamic, as well as the growth dynamic. But hey, they're going to do what they're going to do. It doesn't matter what I think. It doesn't matter what you think. It just matters what the market reaction is thinking and what they're actually doing. And so, if they continue to cut interest rates as the government keeps on printing an absurd amount of government debt on the short end of the yield curve, and essentially debasing the dollar while at the same time growth is staying relatively strong or reaccelerating from the lows, as well as inflation is remaining sticky, you're going to continue to get this stagflationary environment where base metals are going to continue to be the outperformers. And yeah, that's pretty much it, really. If we take a look at which sectors are beating the market so far in the year of 2025, we can see that the best or the top three performers that are beating the market are technology, utilities, and communications. So that's XLK, XLU, and XLC. If you guys just want to take a look at the specific sector ETFs for those, but the rest of them in total, there's 11 sectors. Those aren't as strong. And so really utilities and tech are the largest ones. The main reason being is because there's a massive amount of investment right now, capital expenditure that's going into artificial intelligence, not only for the technology itself, but also the physical materials that are used to create the technology, and the physical hardware that is being built to process that, as well as you have a lot of the utility spaces, right? So the energy required to actually provide the energy to make all this work, right? So the data centers, the infrastructure, all those things is what's also being dragged around, right? So it's the actual minerals itself, as well as the shovels, that are getting the most gain. And I don't really see that stopping here heading into 2026 unless we enter a full-blown recession. But again, it doesn't really look like that's happening anytime soon. And so, party on, essentially, is the name of the game right now. And so, if you were someone who was unable to de-risk before the event on Friday, then I would highly recommend joining our new promotion that we're doing from now until the end of the year, which is our Macro Mastery 6-week challenge. So I got a lot of people sending me DMs talking about, hey, I'd like to really just go head first into your guys' process, really learn what it's all about. How do you guys manage risk and all that? And so we got enough inquiries where we developed this 6-week challenge where the first step is to book a call with myself, one-on-one, actually me, not someone else who works for me. And we'll go over and review your strategy, see what's going on there, and kind of go through what the challenge is. If it's something where you think you wanted to take it on, we can go ahead and get you logged into our partnership circle membership, and you can start the 6-week challenge there. Essentially, it's completing all of our modules, attending meetings. You got some homework there, as well as you have some regularly scheduled check-ins with myself and my team. And yeah, it's a great challenge. It's really based off of how we've seen other people improve a lot within our program. So that is there for you to book a strategy session with myself, and we can get you started there so that you don't have exposure the next time there's a large market correction like Friday. So if you want to expand your macro knowledge as well as learn our process, I would highly recommend you do that challenge, or at least just check it out, hop on a call with me, and we will review it there. Taking a look at the FedWatch tool, though, there's still a pretty large chance that they're going to cut 3 times in a row from now until the end of January, heading into March of 2026. And so that is essentially 100 basis points lower from where we are at right now. And yeah, I mean, that's what the futures market is signaling. That's what the Fed is signaling. The Fed's cutting rates when things aren't really that bad. And that is definitely what is also keeping a lot of the market rally alive here. But yeah, so that's basically what I'm looking at here in terms of the markets. And we can go ahead and get into some of the questions here. Matthew Wright says QBTS RGTI had a beautiful day. Yeah, I mean a lot of the quantum computing slash AI slash semiconductor stocks had a massive rebound today. And yeah, I mean, I think Rigetti, I think it's the best performing stock so far this year in terms of all of the AI and quantum computing ones. Let's see, since the beginning of September, it's up 267, almost 268%. So yeah, Rigetti Computing, definitely one that has been on a major tear. You know, this came back to bullish trend around the beginning of May, right? Kind of went sideways. You know, still remained relatively bullish. Then it had another breakout before it had this huge breakout that's going on right now. For myself personally, you know, it's something where you wouldn't want to buy if you're following the process, right? I can't give direct financial advice, but you know, you wouldn't necessarily want to chase this right here. You would want to wait for another kind of consolidation period similar to what we saw, you know, all the way back at the beginning of this year when you saw this stock had a huge rally up until January of this year in 2025, and then it kind of went sideways and consolidated from January all the way until about the end of June. So it's essentially a 6-month consolidation. Around this time is when you want to start making positions when it does something like this. You don't necessarily want to chase the green candles as it's doing the ramp up, because you're just there's a high probability that you're going to be you know, buying a top there. So yeah, we'll see what happens from here, but a lot of these quantum computing stocks have been the best performers. Can you take a look at Robinhood trading ranges? Sure, we can take a look at those real quick. Yeah, I mean, it's closer to the low end of the trading range, but not quite there just yet. United Health, last time I checked, it was bearish. Let's see here. It does look like it has regained some decent strength here. Yeah, I would say that United Health is back to bullish trend here. And it's getting close to the low end of the trading range on lower volume. And so, yeah, United Health is looking like it's going to attempt to make a comeback here. I know that people were asking me right around here if it was bullish. At this time, it was not. It didn't go back to bullish trend until right here on this move in our model. That was on September 9th. And so this breakout here filled the gap kind of, and I wouldn't be surprised if it does experience some resistance here to provide some good buying opportunities. So United Health, though, is now in bullish trend. Can you take a look at the RRP compared to the TOT? Reese Spinola, what do you mean by TOT? Do you mean by TGA, possibly? The reverse repo facility is essentially drained. The TGA is around 800 million, having a little bit of a bounce in bank reserves. All in all, it's still remaining pretty low in terms of net central bank liquidity. Do you think there will be a blow off top in the metal sector? I mean, that's kind of what we're seeing so far right now. So yeah, it's currently happening. Do you have increased risk exposure this week? I mean, I was buying some things that were at the low end of the trading range last week, but you know, the ones that are in bullish trend, yes. All right, let's take a look at some of the different comments from those on TikTok here. Do you stream only on TikTok? No, I'm actually on YouTube, which is where I'm sharing my screen, as well as on our Instagram page, where I'm also sharing my screen. For some reason, TikTok will not allow me to connect my Apple computer to, I guess they have like their own like streaming software. And so, yeah, the streaming software that I use, unfortunately, can't connect to TikTok. I would need a Windows computer, which I'm not a Windows guy. Good question, though. Appreciate the likes, appreciate the shares. Helps the algorithm. Mineral stocks are up 300%. Is there more room to go up? Possibly. I mean, it just depends if this macro setup continues, which I don't see it slowing down at all. You got to remember that a lot of the metals and minerals, as well as, Bitcoin, or not Bitcoin, gold miners, silver miners, all of those have been pretty much dogs over the past couple years. So, they're just finally having a breakout now. If you guys remember, nobody wanted to touch gold miners or silver miners for the longest time, and it's a new trend this year. RRP and total res. Yeah, I mean, I don't necessarily look at total reserves in depository institutions. I take a look at bank reserves, which is this one right here. India ETF? No, it is not. India is bearish. Let me take a sip of water here. Good questions. Good questions. Yeah, so I mean, we're supposed to get inflation data this week, but unfortunately, because of the government shutdown, we're not going to be getting those. But again, we can pretty much infer what the markets are trying to price in based off of the bond market. When it comes to the hard macro data that comes from these government sources, pretty much what our team uses those for is a confirmation of the trend that's being priced into the price markets, right? We don't necessarily use those in terms of positioning unless it's confirming the trend that we're actually seeing, right? Because the hard data is very lagging, right? It's the reason why they say there's a difference between the stock market and the real economy, even though they are connected. And even in this more financialized world, I think the S&P 500 is a much more of a greater representation of the overall economy than it was before. But with this financialization of our economy, as well as a lot of retail traders, the amount of participation from retail in the markets has skyrocketed. In fact, I think it was last weekend, my dad actually asked a good question based off of the percentage of, out of all the market participants, what's the percentage of institutional traders, of all market transactions, what percentage is institutions, what percentage is retail, and what percentage is passive fund flows, right? So passive funds meaning, people who are just contributing to their 401k plans, and those 401ks essentially just blindly buying their, cookie cutter portfolios, right? If you have stocks like the Mag 7 that are just included in those cookie cutter portfolios, then no matter what price they're trading at, those large passive funds are just going to keep buying them, right? Regardless of the price action. And so what we saw was pretty interesting. Nearly half of the entire market is just those passive fund flows, right? Mike Green calls this the giant mindless robot because it doesn't matter what price things are buying and selling at on the open market. It's just always going to be added buy pressure no matter what. Now, if you watch Mike Green's videos, he's brilliant. Definitely recommend you guys look him up on YouTube. 10 billion times smarter than me, way more experience, but he's someone that I like to listen to and kind of look up to as someone who's a bright mind in the space, in the macro space. And he makes the point that the passive fund flows are a double-edged sword, and at some point, if those do reverse, where there's actually selling going on, then it could cause an enormous crash in the markets, and reverse kind of like what we've been seeing right now with the continuous push-up of this bullish trend. Now, obviously, even if that information is 100% true, that doesn't mean that you go out and just sell everything because you're fearful, right? You still have to pay attention to what the market is signaling currently, which is definitely still bullish. But it is interesting seeing that nearly half of all market transactions are those passive fund flows. And then about a quarter of it, so 25%, is retail traders. And then the other 25% is institutions. So it's pretty interesting, right? What's also interesting is the trend of those, right? So that's really like the snapshot of the current transaction volume, but you're starting to see a large continuous acceleration in passive fund flows. So that's actually going super high. You're seeing a steady acceleration, more of like a 45-degree angle of retail investors, and then you're actually seeing institutional transactions decline. And that's the current trend right now. So a lot of the institutional players aren't as much of the market as they were, let's just say, back in the 80s. And it's really taken a flip-flop where now it's the passive funds as well as the retail traders that are dominating it. So in this new environment, like, you have to adapt, you have to. You can't just think that the markets are being ran by just institutions buying and trading it all day. Is your team looking at any international ETFs? Yes, there's a bunch of them that are in bullish trend. Jimmy. Trying to understand why Japan's 30-year bond yield is at 3.32%. This is the highest ever. What's there to understand about it? They're hiking rates. Because inflation is accelerating in Japan. What's that guy's name again? Mike Green. Mike Green. So, thoughts on GLD? We covered it at the beginning, but GLD has been one of the best performers over the past couple of years, and we remain bullish on gold. No changes there. But yeah, again, if you guys want to accelerate your guys' macro knowledge and actually be able to not exactly time the markets, but really make sure that you're not super exposed when these large downturns happen and be able to risk manage capital more appropriately. Right now, we're doing a 6-week macro mastery challenge. If you guys are interested in that, go ahead and click on the link below or in the description or on my profiles, and you can book a strategy session with myself. And there's some application questions here, but pick a time, book a call with me, and we'll go over everything on there to see if it's something that you would want to partake in. Just by booking a call, you're going to get our entire toolkit of all the trading indicators that we use on TradingView. As well as, if you do decide to have the challenge, you're going to have access to the entire Partnership Circle membership. So, that means that you're going to get the trading range model as well as the 5 other private indicators that our team uses. And it's really meant to just, accelerate your use of macro so that you're staying ahead of these huge market shifts from now on. But again, just go to the link below, fill out a time, and we can go ahead and have a discussion on that. But that's all I have for you guys here today. If you guys have any questions, shoot me a DM. Myself or my team will go ahead and answer you for those. Appreciate everyone for joining. Have a great rest of your Monday, and we will catch you in tomorrow's daily macro update. Bye, everyone.